All right, let's dive right into this. Welcome back to another explainer, where we're taking a totally fresh look at managing your wealth. So, quick question for you. What on earth does managing a championship-winning football team, like, say, witnessing that incredible decade of Mo Salah and Andy Robertson at Liverpool, have to do with crushing the stock market? Sounds like a total stretch, right? But the author of the Fat Investor blog had this brilliant realization. What started out as just a fun little analogy is actually completely transferable to achieving some seriously great investment results. Today, we're going to break down 7 years of portfolio tracking data to see exactly how building a winning stock portfolio is basically the exact same thing as building a legendary football squad. Let's get into it. You can see this classic 4-3-3 formation here, and it brilliantly illustrates our whole metaphor. Your portfolio? It isn't just some random collection of assets you threw together on a whim, hoping for the best. No, it is a highly structured starting 11. Think about any world-class football team. You've got your star strikers, those flashy forwards whose entire job is to aggressively hunt for growth and score those massive goals. But right behind them, you have your reliable defenders. These are the unsung heroes who give you that structural stability and, crucially, prevent catastrophic losses. Look, you literally cannot win a championship with 11 attackers, and you definitely can't build generational wealth without a carefully balanced roster. So moving on to our first major lesson from the manager's playbook, and it's an absolutely crucial one. Letting your winners compound. We're talking about those star strikers. Look, almost any stock can have one great year. Kind of like a player just having a lucky season. But only a very rare few can consistently repeat those stellar performances over a multi-year cycle. When a company actually demonstrates that ability to compound its wins year in and year out, it's signaling a seriously powerful underlying growth engine. I mean, you wouldn't just sell Mo Salah when he keeps scoring season after season, right? So you absolutely shouldn't let your high-conviction compounders go too easily either.
Just to put this into perspective, take a look at the data on some of these massive winners. We've got Arista Networks, ticker ANET, sitting at a staggering 898% return. That is literally almost a 10-bagger. Then you have AEM at 478% and iFAST at 319%. Now, the author does note that letting your winners run means they might grow so huge that they start dominating your portfolio. And honestly, it's totally okay to take some money off the table so you can sleep well at night. But here's the absolute critical takeaway from this. Unless there's some sort of fundamental structural deterioration in the underlying business model, completely divesting your top compounding players is almost always going to be a massive mistake.
But to actually keep those stars, you really have to survive a grueling multi-year season. Let's clearly contrast two things that investors constantly mix up: share price volatility versus actual business performance. Short-term stock prices, they are incredibly volatile. They get tossed around by fickle market sentiment, random geopolitical noise, maybe a missed analyst expectation, or honestly, just pure herd mentality. All of that is just noise. But on the other hand, we have business performance. If you look under the hood of successful companies during those exact same noisy periods, you'll see they often just continue to report robust, highly profitable results driven by real, underlying fundamentals.
And that brings us to a pretty harsh truth, one that requires immense psychological discipline. Volatility is simply the toll you pay for market-beating returns. It's the price of admission. Now, to be crystal clear, the volatility we're talking about here refers strictly to the share price, not the actual business itself. Think of it like this. A world-class manager doesn't just dump their absolute best striker because they hit an abysmal patch of form for a couple of games. In the same way, you shouldn't abandon a structurally sound business just because it hits a temporary, short-term low in its stock price. So let's see how this actually plays out over a long campaign with some real historical data. Looking at 7 full years of scouting data, we can see exactly how many times specific stocks appeared in this portfolio's top 5 annual performers. Notice Arista Networks and iFAST up there with 4 appearances each. Micromechanics makes 3 appearances. These phenomenal players frequently sit right at the top. They are the engines that are literally driving the alpha in the portfolio year after year after year.
But wait, immediately contrast those top-tier appearances with these bottom-tier slumps. Take a close look at these names. iFAST, 3 times in the bottom 5. Micromechanics, 2 times in the bottom 5. Arista Networks is definitely known to visit the cellar too. I mean, this brilliantly illustrates that these exact same long-term winners routinely plummet into the bottom 5 tiers. It basically proves that even the absolute best players experience severe, temporary slumps. If you don't really grasp that concept, you're going to end up selling your best assets at exactly the wrong time.
Now, you might be wondering, what about the new guys, the academy players, so to speak? Well, this is exactly where the tactical side of squad rotation and position sizing really comes into play.
For businesses that look structurally sound, but where you maybe haven't quite built up full confidence or conviction yet, it's always super prudent to hold a much smaller position. You let the academy player get some minutes on the pitch to prove themselves, but you definitely don't thrust them right into the starting 11 on day one, do you?
Let's actually walk through the specific risk management strategy the author used with AEM Holdings. First, you identify the potential. In this case, the CEO had very clear strategic growth pillars. Second, you hold a small position. Because AEM was facing some real operational challenges and execution was a bit uncertain, the position size was kept strictly under 2%. Keeping that position size so small significantly reduced the downside risk. And crucially, that gave the investor the emotional breathing room to just hold on without panicking. The result? They were able to ride out the turbulence until it turned into a massive 478% winner.
We do have to emphasize the flip side of this, though. You absolutely must maintain a balanced team, and that means pruning your tactical mistakes. As the author points out, when players consistently underperform, they need to be sold. You have to be willing to prune ruthlessly. For example, a change in tactics might mean pulling out-of-position players off the field entirely. The author completely divested 3 Mapletree REITs and consolidated them into the iFAST STC Asia REIT ETF, specifically just to free up cash for better market opportunities. Long story short, you have to be willing to cut what simply isn't working to feed what actually is.
And that leads us right into lesson 3. Every single stock has a specific role. Remember, you don't win a game with 11 attackers. Mo Salah himself actually once said that without the hardworking midfielders covering the ground, the team wouldn't have won anything. Every single portfolio needs those unsung heroes out on the pitch. They don't make the flashy, viral growth headlines, but they are absolutely essential to winning the championship campaign.
We are, of course, talking about your defensive anchors. In this specific portfolio, names like DBS, OCBC, Parkway Life REIT, HRNet Group, and the Hourglass totally fit the bill. These companies might honestly even appear in the bottom 5 lists sometimes, yet they still manage to produce a solid, positive long-term return. Their steady cash generation provides that structural defensive ballast you so desperately need. They just quietly churn out steady returns in the background without causing even a shred of portfolio anxiety. And that peace of mind, that's exactly what comfortably allows you to hold on to those highly volatile growth engines we were talking about earlier.
Ultimately, looking back at 7 years of data teaches us one major overarching lesson. Long-term investing really isn't about finding some flawless, magical portfolio where nothing ever drops in price, because that doesn't exist. At the end of the day, the decision to sell or hold boils down to a pure judgment call. And that judgment call has to be based entirely on your personal understanding of your investment's underlying business fundamentals. You are the manager here. You have to know your players, understand their roles, and know whether they're fundamentally sound deep down. So I want to leave you with this final, somewhat provocative thought. Take a really good look at your own portfolio today. Are you panicking over short-term market volatility and cutting your best compounding players way too soon? Or, just as dangerously, are you out there playing without a solid defense in your starting 11, risking a total collapse the second the market turns against you? Take a page straight out of the manager's playbook. Structure your team with actual purpose. Let your star strikers compound, and let your defenders do the heavy lifting of keeping your mind at ease. All right, that's it for today. Thanks so much for joining me on this explainer, and I'll catch you in the next one.